All right, this is the sixth question, question number 6 in Chapter 5, Lyrics Lab in Business 353, Intermediate Financial Accounting 1. Here we have a situation where we have a long-term contract. The initial contract was for $2.6 million, as shown here, and as shown down here. So $2.6 million was the original amount of the contract. The original total costs, if we add up the cumulative costs to date at the end of 2015 plus the estimated cost to complete the project, that adds up to 2.1760 plus 440. That'd be $200,000, $2.2 million, which means that we're going to make $400,000 on the project. That was the plan in 2015. Unfortunately, in 2016, we had some labor difficulties. We didn't have a sufficient pool of skilled, right, as it says right here, a sufficient pool of skilled laborers. So it's going to take us a little longer to finish the project, and the price of steel went up, which is also bad. So there were cost overruns in the project. So they negotiate a partial recovery of these extra costs. The total extra costs worked out to $3.4 million. So our revenue $2.9 million. Our total costs we're expecting of $3.4 million. That's a $500,000 loss. And we've got billings and cash information here as well. So at the end of year 2016, we're expecting to lose $500,000. Turned out it wasn't quite that bad. In 2017, we determined that the total costs we actually expended were $3.3 million, so not $3.4 million, and so we actually lost only $400,000, not $500,000. So, first question, calculate the amount of gross profit to be recognized each year using the percentage of completion method. So in the first year, our gross profit is going to be determined by the amount of revenue. So the amount of revenue, whoops, what happened there? We have 440 out of a total cost. So we're taking the percentage of cost, 440 plus 1760, and multiplying that by 2.6 million. And that's the amount of revenue we've earned, 520. And of course from that we subtract the cost to date. Whoops, I don't know what I did there. Oh, okay, we're still good. So go to the end, hit the end button, then subtract 440,000. The cost to date means we have a gross profit for the year of 80,000. Now in the second year, we've got a number of different items which we'll have to include in the journal entries down here. But essentially at this point, the gross profit or loss for the year, we need to recognize there's a loss of $500,000. But we also need to recognize that we recorded a gain the previous year. We have income of 80,000. So 580,000 is the total amount of loss we have to recognize this year. We have to undo the gain that we recorded the previous year and record the fact that we've got a loss. So we record the loss in anticipation of loss. If we had an expected profit, we would only record the proportion or the percentage of completion. And then in the last year, it turned out that we actually didn't lose as much money as we thought. So we actually can record a gain of $100,000. And so net over the entire project, we add up those three, and they add up to a net loss of $400,000, which is what we actually realized in the year 2017. Now it says to prepare all the required journal entries for the year ended December 31st, 2016, and that means that we need to record the revenue entry, we need to record the billing entry, the cash collection entry, and the entry to recognize the construction costs. So all of those have the December 31st date, so you can do that 31/12, and then you can just carry that all the way down. You need to actually carry it into the cell, which I'm having trouble doing with my fancy touchpad mouse here. Okay, so the first period, we're going to need one more line there. We're going to need one more line in the third one as well. Actually, I'm wrong. You don't need one in the third one, you just need one in the second one. So first of all, we need to calculate the amount of revenue. So let's put that here. Revenue. And the revenue amount is what we calculated. The proportion of 2312 out of 23, whoops, get inside the bracket here, 2312 plus 1088. So that tells us that we're 68% of the way finished. That's kind of important to know. So let me just drag that over here as a temporary placeholder. 68% is what we've actually finished. Now we need to record the amount of revenue. That implies 2.9 million is our total, so we've earned 1.972 of the revenue. Now, our construction costs, the construction expenses right here. Not quite sure we didn't have construction revenue, but revenue is what we got there. So construction expenses is the actual expenditure during the period plus the recognition of the unrecognized portion of the loss. So we've recognized 68% of the loss when we record the construction expenses. So let's see how that works. It's going to be 2312 minus the 440 we recognized the previous period. That works out to 1872. But we haven't recognized the portion of the loss which isn't included there. So after the first year, we've got an expected loss of 3.4 million in costs versus 2.9 million in revenue. That's an expected loss of $500,000. So we need to add to these expenses 0.32 times the loss of 500,000. So that number, that's probably the trickiest one. So let me pull it aside here. Is the 2.312 million we expended up to the end of 2016 minus the 440 which we recognized the previous year. So that's the total amount of paid construction expenses. That recognizes 68% of the costs. So the rest of the costs, the other 32%, need to be incorporated as well. So 32% times the loss of 500,000 gets added into our construction expenses. And as a result, we have construction in progress account, which is the balancing figure. Whoops, that's not what I want. Try that again. Construction in progress. There we go. And the difference between these two, 2032, minus, and remember, if we hit the shift key and move the arrow, hit the arrow key, that'll move it out of our way. 1972. Alright, that's not really what I wanted. What I wanted was my revenue number. I think right. That's my problem. Let's go here. Let me drag my revenue number here. This is just recognizing the 68%. We recognized about $500,000 of that revenue the previous year, so we need to remove the portion which we recognized in the previous year. So let's do that. 1,972,000. Go to the end, and we need to subtract from that the proportion we recognized the previous year. So 440 out of 440 plus 1760, and that was calculated on the basis of the 2.6 million. So 1452. Okay, that's looking more like what we want, and so we want this number to be the 2,032,000 minus. Once again, shift. Let's go down arrow this time. 1452. All right. That's making more sense. So our construction in progress account is actually negative by 580,000. We actually have a construction liability, I suppose, of 580,000, and that's consistent with the profit or loss we've recorded up here. So we need to get rid of this. Let's backspace out of there and hit enter. Okay, so that entry was to recognize the revenue. Alright, next couple are fairly straightforward relative to the others. We have billed 2.5 million to date. So of that portion, our accounts receivable, oops, that's not the one I want. I want it up here, so it'd be nice debit. It's 2.5 million minus 400,000. So we billed 400,000 last year. We billed another 2.1 million this period. That's the 2.1 million right there. So since it's the same number, let's just drag it over here. But of course, that's not accounts receivable. That's billings on construction. So that's essentially our unearned revenue, or our deferred revenue, that we're going to settle up with when we get to the end of the project. And this is to record billings. Then, of course, we collected some of that accounts receivable, so we got some cash. The amount of cash we got is 2.4 million minus 400,000 we collected the previous year. So 24000 to date minus 40000. 2 million collected this period, which of course reduces the accounts receivable. And that's to record collection, if you will. All right, then the last entry. This is to recognize the fact that we have expended a bunch of money for the construction expenses. We've actually sort of paid them either out of our material or set them up accounts payable or in some other way. So to recognize the expense side, so to record construction costs, we need to record the fact that we expended we want costs construction in progress. This is the expense side of the inventory, and so that recognizes the 2312 minus the 440 we expended in the previous period. So we spent $1,872,000 on construction expenses this period, and so that goes to we have this account called materials, payables, cash, etc. However we actually paid them, whether we paid our employees and allocated part of their wages, or whether we took our construction materials out of our own inventory or paid for construction materials out of cash, whatever. Those all are the cost side. So the first entry is the revenue side. We ended up with a sort of net loss, right? Our construction expenses of $2,032,000 versus our revenue of $1,452 recognizes the fact that we've got a construction loss, and that has to consider the loss this period offset against the $80,000 of profit the previous year. So it's the same number as we've calculated here. And then in the last entry, our construction progress 1872 is what we actually paid, what we actually expended during the year in costs, and we record that as a debit to construction progress. So our construction in progress account is the net of these two, 1872, plus the previous year's items, which would have included the 440,000 that we expended down here, and the revenue would have been the proportionate amount of the revenue up there to recognize the proportion of costs completed, the 440 divided by 2.2 million of total costs times the 2.6 million of revenue. So that's all the journal entries. The revenue amount is just this period's revenue, and the construction expenses are the construction expenses that we've incurred plus the additional amount of the loss that we haven't yet recognized. So the 68% of the loss is actually recognized in the revenue minus the construction expenses, which are included here, but the other 32% hasn't been lost yet, or hasn't been recorded yet, which gives us a balancing figure, construction in progress $580,000, which is consistent with our gross profit or loss for the period. So then we've got a note here that says, assume that the increase in material costs has created significant uncertainty for the contract, which means that we're going to use one of the, I'm not quite sure what happened there. We've got items showing up over there. Strange. All right, I figured out how to get rid of them. Now, we're assuming that the increase in materials costs has created significant uncertainty for the contract, which means we're not going to record the contract under the percentage of completion. We're going to record only the percentage of profit which we've sort of earned, and since we're using the zero profit method, that means that we don't think we've earned anything. We're not sure we're actually going to get paid for the remainder of our project. So that means our revenue the first period is basically the same as the amount of the expense. 440,000 there, and 440,000 there. So we record the revenue to match the amount of the expense. We haven't recognized any profit at all because of the uncertainty in the contract. So the zero profit method results in zero profit. Then the next period, our total expenses that we've expended are these 1872 we calculated right here. So let's put that in as a starting position, and we can take that as our revenue. So if we were doing exactly the same as we were the previous period, we've expended 1872 of more expenses. We can recognize that revenue. We still haven't recognized any profit on the transaction, but the problem is we now recognize that we have a loss. So we actually have to record the amount of the loss in addition here, so that we have the $500,000 loss recorded as our expenses. So essentially expenses and losses are treated the same under IFRS, and the expense, the $500,000, would then show up as a loss in the second year. So we're recognizing the loss in advance. It's more prudent or conservative than recognizing it when it actually happens. So we recognize the fact that we're losing money on this contract. We record that in 2016. Then in the last year, the amount of remaining revenue is the 2.9 million minus the revenue which we've recorded here. Whoops. It would be good if I could type 588,000. So if we add those three together, that gives us our total 2.9 million of revenue. The expense then is just 488,000 because we've already recognized the $500,000 loss here, and it turns out that we actually have a $100,000 reduction in that loss. So the total loss for all three of those entries, or all of three of those mini income statements, I guess, would have been a $400,000 loss in total, which is consistent with what we have. We can also, if we do a little practice, a little test down here, we got 3.3 million is our total expenditure. We recognized 440 and 2,372 in previous periods, so that works out to 488 as well. So there's a couple of ways you can calculate 488. You can just recognize that you've got $100,000 more, or $100,000 less loss than you had set up in 2016. Or you can take the remaining expenditures, the remaining expenses, and subtract the expenses you recognize in the first two periods. Alright, so let's get rid of that in our little check box here. Now, the ASPE method, completed contract method, is acceptable for ASPE, where it isn't acceptable for IFRS. So in the first couple of years, we just recognize nothing because we haven't completed the contract. So in both of those years, we have revenue of zero. Our expenses the first year is also zero. But in the second year, we need to recognize the fact we're losing money. $500,000 of loss gets recorded there. And then at the end, we record all the revenue together at once. And because we've already recognized 500,000 of expenses, we recognize the rest of the 3.3 million. $2.8 million there. So that's all there is to it. So quick summary. We should drag this aside so you can see how the calculation is. No, that's not the one I want. This construction expenses number, 2.312 million minus 440, which we recognized the previous period. That's the new expenses, new expenditures this year, so that's the same as the 1872 at the bottom. But we also need to recognize as a loss this period 32% of the $500,000 of total loss that we're expecting for the contract. That's it. Let's see what Lyrics thought of all of this. Lyrics agrees. We're done.